So if there's different, but really it's just a bit about different strategies and trading strategies. So buying dips in established trends.
Buying dips in established trends, I think, is, it's all about moving averages for me. I think they're just perfect for that sort of thing. You have them rising near term, daily chart, and it's a bit like Fibonacci in the sense you're trying to guess which of the points, it's 25, the 25% or the 38% or 50% retracement, but you use the moving averages as a guide in terms of, on the FTSE at the moment, the 20-day moving average is in play in terms of being support intraday. And that's, actually with the FTSE, it's quite a good example that on the way up, you tend to buy on dips to say the 10-day moving average, and then if it breaks below the 20, then you would sort of take the view that the trend has changed near term and you should stop buying the dip, for instance. In stocks or in stocks as a whole, it's well established that fund managers will be buying dips towards the 200-day moving average, and if that changes or that breaks on a sustained basis, then they'll be going the other way, or they'll stop going long. So the dips to buy into moving averages, and obviously the other way around as well with the selling into strength.
By relative strength.
Relative strength, I don't really go for that. I don't go for that very much. I don't go for pairs trading. The relationship between markets, if that's what you're trying to point to, tends to be a type of thing which tends to, you can have aberrations which last longer than your wallet can afford. So that's why I tend to sort of get, it's like at the moment it's the trade could be, buy Barclays, go short of RBS. And there's a £1 difference between the two share prices. You can bet your bottom dollar that, it should be the case that you go short of RBS by Barclays, but having said that, there'll be some announcement or there'll be something happening with the Royal Bank of Scotland, and it gets taken over by Citigroup or something like that, and the relationship is just out the window, all this speculation. So I tend to avoid relative strength and relationships between different markets and different stocks.
What about selling rallies?
Selling rallies, I tend to not do that. I tend to go with the flow. I think even if it's not necessarily the right thing to do historically or statistically, I think it's better to have a strategy which you're comfortable and familiar with, and control that, and be aware of the pitfalls and the pros of that strategy, rather than trying to go opposite to the market in that case. I know a lot of people who think they're very flash tend to go to sell into rallies and trying to look, especially on indices, looking for a bearish slant, but I avoid that.
And finally, buy support and sell resistance.
Buying support and selling resistance is a great strategy. 80% of the time, or statistically shown that the markets are in a range, and obviously then that's the way to go. The problem is, it tends to be the case that the more certain that range is, the more fake outs you have at either end of the range to make it look like either the range is going to break to the upside or the downside, or just to stop you out. So it becomes a bit of a stop-loss hunting exercise, which, if you're experienced and seasoned in these matters and you don't jump the gun, you'll do well, but you could still actually lose a lot of money trying to trade a range, which is actually relatively stable, but where there's just enough volatility at either end to confuse you.